The price drop looks calm until the oil market starts making no sense.
It's like the price of gold or silver or any other commodity. And so when this war started, the price was maybe $70, something like that. I think it was about $70, $72, something like that. That would be the end of February. So again, the war is taking place at the center of the global oil trade, which is the Persian Gulf. And so naturally, the price went up. And then in April, the Strait is closed, and oil predictably shoots up to, maybe getting the number wrong, but maybe $118 a barrel for Brent crude. And that seemed honestly a little bit low, considering that 20% of global oil just got taken off the market, just wasn't flowing out of the Gulf. And there was also extensive damage to oil extraction facilities, to oil refineries, to petrochemical plants. I mean, there's a lot of damage, not just to the oil wells, but to all the downstream machinery involved in refining oil. So anyway, it seemed a little bit low, but at the end of April, it reached what turned out to be its highest point, and then it did something quite amazing. It went down. There was a time this month, with the Strait basically still closed, when oil, as priced on the Brent crude market, oil was cheaper by a few cents per barrel than it was before the war started, even though the Strait was closed. Now, you don't have to be Larry Summers or a Harvard-trained economist to wonder, what the hell is that?
The argument lands on a real contradiction. A war in the Persian Gulf should have choked supply and pushed prices higher. But the bigger assumption is that visible damage and a closed strait must show up immediately in Brent, and the transcript admits the number may be imperfect. That leaves two possibilities on the table. Either markets were pricing in a reversal, or the quoted benchmark was already drifting away from physical reality. The surprise is not just that oil rose, but that it later fell, while the disruption still looked severe.
How could that possibly be? You take 20% of the supply offline, and the price goes down? And you hear people say, well, China stopped importing a lot of oil. True. But this is a market, and the people investing are basically making a bet on what's going to happen in the future. These are futures. So China can't stop buying Gulf oil forever. And there aren't an extra 20 million barrels a day of oil anywhere on the planet that we could just
That objection is fair, because futures are forward-looking, not a live tally of tankers at sea. Still, the reply here is incomplete if it stops at China's demand shifts, because temporary demand weakness does not fully explain why a massive supply shock gets treated as reversible so quickly. The real issue is whether traders are reacting to short-term consumption data instead of the longer replacement problem. If so, the market can look rational while still mispricing scarcity.
The fabled pump.
The pump. Well, this is interesting because we have the quoted price of oil, the futures price, right? 85 right-ish now for WTI, maybe 95 for Brent. But on the other end of that, I don't put oil in my car. I put gasoline in my car.
Right.
So
That's
the
right.
question is, after it goes to the refiner, how much are those products worth right now? Okay, so if you in Rotterdam this morning wanted to buy a barrel of jet fuel, you had to pay $158. If you want to buy a barrel of diesel, same market, about $148.
Whoa.
So that's what it's actually selling for.
Well, what's the point of having a Brent market, WTI, West Texas? What's the point of those numbers if they don't correspond to reality?
It's a narrative control. It's really, I think that's what we're down to at this point in time. So
The most useful point here is the split between paper oil and the fuel people actually buy. A Brent or WTI quote can look tidy while jet fuel and diesel in Rotterdam tell a much tighter story. But calling that pure narrative control goes a bit far unless you separate benchmark pricing from refined product pricing and delivery costs. The sharper criticism is that the headline crude price may be too abstract to guide what drivers and airlines ultimately face at the pump.
however, on top of that, we've allowed, because our regulators fell asleep at the wheel, we've allowed the speculators in that story to become 50 times larger on a signal basis than the actual deal that happens at the bottom. So when you have a 50-to-1 margin, it's the paper that's setting the price up there right now. And we've watched this for years, 1:30 in the morning, and this is happening with oil now constantly. 1:30, 2 o'clock in the morning when there's almost no trading happening, everybody's asleep. And all of a sudden somebody will come in, and I've seen this several times now, and suddenly sell 1.5 million barrels of oil in a single 1-minute window, and it just crushes the price. And they do this over and over again. And then, of course, you have all these algos, and they're mostly momentum. A lot of them are momentum algos. And so they're like, oh, look, prices are falling. So they pile on, and you get the whole sort of herd moving in a direction. And it's just completely fake. It's been this way for a while. And I think
The complaint about oversized speculation has teeth, especially when paper volume dwarfs physical barrels and algorithms amplify a sudden move. But the transcript also leans on dramatic intraday examples, and those need care because fast price swings do not automatically prove manipulation. What follows from this setup is more troubling. If thin trading windows can move the benchmark, then the price signal becomes unstable exactly when supply is under stress. That makes the market easier to herd and harder to trust.
For.
It's a big mystery. So here's the thing. You mentioned the most important thing. There's like, if you take economics, there's one chart. They call it the PQ chart, price, supply, demand, right? There's a curve. You can point to it. That's how it's supposed to work. Right now, we're holding the price lower than actual supplies, right? So what's happening is demand is too high. And so we're burning through our stockpiles right now. And if you want to see something alarming, just look at the actual amount of crude oil we have stored in the United States. That would be the SPR plus commercial inventories. Or we could look at how much diesel do we have in tanks kicking around? Hey, or how much gasoline do we have in tanks? And all of these are just powering low. Now, why is that? Because the price is too low. The only way you can get price, supply and demand matched again is you have to use prices. So prices rise enough, people decide, I'm not going to drive my car today, we'll take a lesser vacation, whatever. That's how this thing sorts itself out. Alternatively, and I'm really worried about this in a post-COVID.
This part makes the cleanest economic case. If inventories are falling, the system is telling you price is still too low. The catch is that low prices today can feel good while silently burning through the buffers that keep tomorrow's supply stable. Once stocks get thin, consumers stop having a cushion against shocks, and the adjustment gets harsher later. So the real danger is not just a temporary mismatch, but a delayed correction that lands after the reserves are already drained.